Hello everyone. After seeing the benefits of investing, the next question arises: where to invest and which investments give consistent returns? As a retail investor, you have the following options to invest your surplus cash: fixed deposits or bonds, which are essentially part of fixed income instruments, equity stock market, real estate, commodities like precious metals of gold, silver, and other such things. Now let's discuss them one by one. Coming to the fixed income instruments. Type of fixed income instruments include fixed deposits in bank, bonds issued by the Government of India, bonds issued by the government related bodies like NHAI, bonds issued by the corporate companies. Yes, they also issue their own bonds. So now here the question arises: what return can you expect by investing in fixed deposits or bonds? It generally varies from one bond to another or one bank to another in case of fixed deposit, but generally an investor can expect 6 to 8% return per annum by investing in these type of instruments. These fixed income instruments have very little risk and to the principal amount paid, and the return is paid as interest to the investor. The interest could be paid quarterly, half yearly, or yearly. Now let's come to the equity stock market. Investment in equity stock market can be done by investing in shares of publicly listed companies of NSE, which is National Stock Exchange, and BSE, that is Bombay Stock Exchange. So consider NSE and BSE as the two markets where you can purchase shares just like you purchase any other commodity from any supermarket. Here in equity, there is no fixed return, but if you invest in a good stock, the returns of that investment can beat returns from the fixed deposits or bonds. In India, some of the top large cap companies have given 20 to 25% CAGR over the past 15 to 20 years. So if you invest in stock market for a long term, you can definitely beat returns obtained from that of fixed deposit or government bonds. In fact, investment in equities is the only way to beat inflation over a long period of time. Details about how to invest in stock market and details about strategies in stock market will be discussed in further videos. So keep watching closely. Next we'll discuss real estate. Real estate in a good location can give you good returns, but the major disadvantage of real estate is that it requires a huge capital in a single go. Most retail investors don't have such kind of money to invest in one go, and most of them end up taking up a loan to fund their dream of owning a house. Real estate investment can be of two types: buying a commercial property or buying a personal property like land, flat, or a house for personal use. So these are the two sources of income from investment in real estate: rental income and the appreciation in capital. Transactional procedure can be quite complex regarding the purchase and sale of real estate, which often involves legal verification of several documents. As explained earlier, a very huge investment is required in real estate, and in some very good location, it gives a good ROI, but on average, these returns are less compared to the returns generated in the stock market. Next, we'll discuss commodities. Commodities investment often involve investment in gold and silver, since these are the two commodities which are very popular. Gold and silver over a very long period of time have appreciated in value. On average, their appreciation is 7 to 8% CAGR over the last 15 to 20 years. A retail investor can invest in gold and silver by either purchasing jewelry, gold, or silver biscuits, or investing in gold and silver exchange traded funds, commonly known as ETFs. Too much investment in gold and silver is also risky, as commodity prices fluctuate in cycles, and there might be an instance where gold and silver might be trading at a price below your purchase price. Additionally, if you are buying gold and silver and keeping the jewelry at home, there is also a security concern of theft or any other similar situation. To avoid this, one would think that they'll keep their gold in bank lockers, but essentially that is a poor decision, as you get no interest for the amount of gold kept in the locker. Rather, you have to pay some charge to the bank in order to maintain that locker. Instead of this, one can keep cash in fixed deposit, as that way there is no liquidity concern which often arises when you have gold with you. So, how should you invest smartly? A smarter way to invest is to have some investment in all four types of asset classes, as this will diversify your portfolio. Hence, your portfolio will be hedged against any kind of external risk. An important thing to note here is that risk and return are often directly proportional. That is, higher the risk, higher the return on investment. So now we reach towards the end of the video where we learned about different forms of investing. So in the next videos, we will discuss more on such topics related to investing and trading in stock market, which will help you achieve your financial goals. So see you again till next time. And until then, do make sure to subscribe the channel and click on the bell icon to receive updates about further videos.